Ouch, I saw Microsoft just 2 days before earnings and completely missed the 15% pop. Listen in as Gemini Notebook breaks down my latest post, why I made the mistake, and why this wrong move might actually turn out right.
Right, let's jump straight into this explainer. Today, we're unpacking a really deeply human, incredibly fascinating, and honestly painfully relatable case study from the Fat Investor blog. We're going to deconstruct the anatomy of a classic mistake. What exactly happens when a disciplined retail investor decides to sell a world-class compounder right before a massive earnings beat? Look, we have all been there, right? Second-guessing a move. But what makes this specific explainer so powerful is how we can learn from the actual mechanics, the psychology, and the underlying data of this exact trade.
Picture this for a second. You've done your research, you make a strategic portfolio move, you go to sleep, and you wake up only to see the stock you literally just sold skyrocket by 15% overnight. It actually eventually ticked up to 19%. Now that is the kind of immediate market reaction that can easily make you sick to your stomach. It's a massive overnight surge that, let's face it, most of us spend years waiting for in our own portfolios.
The sheer, immediate regret is just perfectly captured by a single thought from the investor. I can't believe it myself. It really highlights the deeply human element of making a poorly timed execution. Because selling a powerhouse like Microsoft just days before they report earnings, that is completely out of character for this highly disciplined investor. And the market's punishment for this little timing error was absolute, and it was immediate.
To truly understand the scale of this misstep, we first have to take a look at the phenomenal numbers Microsoft put up on the board. I mean, they completely shattered expectations and sent Wall Street into an absolute frenzy. The sheer scale of this beat was just staggering. Revenue hit $90 billion, which is up 18% year over year. Net income surged 31% to $35.8 billion. But the real showstopper, Azure cloud revenue accelerated at 43%, officially crossing the $100 billion annual run rate for the very first time. And they managed to do all of this while generating a robust $19.6 billion in free cash flow, easily absorbing their massive capital expenditures.
Having the actual trade receipt right here grounds the whole story in undeniable reality. You can see the investor sold 22 shares of Microsoft at around $390 just to buy Netflix, Intuitive Surgical, and Alphabet. Seeing the actual transaction really drives home the day-to-day reality of portfolio management. You just can't hold everything forever if you want to capitalize on new opportunities without constantly injecting fresh cash. So the question is, why make this specific move?
Well, let's break down the logic, because the investor wasn't just throwing darts at a board. First, they were actively hunting for opportunity buys. Alphabet, Intuitive Surgical, and Netflix had all delivered really solid operational results, but Wall Street had kind of just shrugged, so the investors saw a chance to grab high-quality compounders at a discount. Second, and this part is absolutely critical, they strictly adhere to their asset allocation rules. They have a strict mandate to keep a 3-year cash buffer completely untouched. So step 3 becomes inevitable, right? To fund these new additions without adding fresh capital, they had to rebalance, which meant they had to sell something.
So why did they choose to cut Microsoft? The blind spot here was a severely flawed short-term assumption. See, the investors saw the market react very flatly to Alphabet's solid numbers, and they just assumed Microsoft would face the exact same fate. But the reality on the ground was vastly different. Alphabet had spooked investors by dipping into negative free cash flow. Microsoft, on the other hand, was deeply cash flow positive, and Wall Street heavily rewarded that robust cash position. Which brings us to a massively important concept that totally caught our investor off guard, and that is seasonality. Seasonality in tech cash flows basically refers to those regular, predictable fluctuations that are driven by the calendar. In Microsoft's case, it's all about their annual enterprise software renewals. The investor simply failed to account for this predictable surge that reliably delivers peak cash collections in Microsoft's final fiscal quarter. When you compare Microsoft and Alphabet's cash flow cycles, you see the exact trap the investor fell into. Microsoft's fiscal year-end, which aligns with the calendar second quarter, creates a massive peak collection rush. Their operating cash flow literally spikes up to $42.6 billion and $55.4 billion in those Q4 peaks. Alphabet, meanwhile, is on a totally different cycle. So by expecting Microsoft to trade exactly like Alphabet in this specific calendar quarter, the investor was essentially comparing apples to oranges on a cash flow basis. But you know what? The plot thickens when we look ahead, because that massive cash flow beat might actually just be a seasonal mirage. Going into the next 2 quarters, Microsoft's cash flow is likely going to step down following that huge year-end rush. Plus, they are now extending their data center life from 15 to 25 years. That accounting shift moves lease payments directly into operating expenses. Combine that with a staggering $50 billion capex guidance for Q1 2027, and Microsoft's headline free cash flow could temporarily contract or, hey, maybe even go negative. The big takeaway here? Single quarter cash flow swings are very often just seasonal and accounting noise, not some kind of structural change in the underlying business.
And all of this leads us to a really fascinating paradox. The trade itself was definitely a misstep in execution. I mean, acting right before an earnings catalyst rather than just waiting a few days for clarity was an unforced error. Even if the stock had plummeted, it still would have been bad execution. But, and this is a very big but, it was still structurally the right move for this investor's specific portfolio.
So why was it the right move? Well, it all comes down to conviction. As the investor realized, investing is ultimately about holding on to great companies through insane volatility. They realized they simply felt a stronger personal connection and conviction toward Alphabet, Intuitive Surgical, and Netflix than they did toward Microsoft. That psychological alignment, that's your armor. It's the exact emotional fortitude you need to prevent yourself from panic selling when the market inevitably takes a nosedive.
Zooming out to the bigger picture, this whole situation reveals the ultimate philosophy of the fat investor. The goal of investing isn't to be this flawless, emotionless execution machine. We're human. We are all prone to weird impulses and silly timing calls. The actual goal is to build a resilient portfolio foundation. You want a system so robust that when you inevitably make a minor misstep, you can just laugh at your own silliness, learn the lesson, and keep moving forward.
And the proof is in the pudding here. This mistake didn't derail the portfolio at all. Why? Well, first, sentiment swings both ways. Alphabet quickly recovered, gaining over 9% shortly after the trade, which definitely softened the blow. Second, smart position sizing. Microsoft was just one of 10 smaller U.S. growth positions for this investor. So that painful 15% surge, it barely moved the needle on their total overall returns. The portfolio's solid foundation easily absorbed the shock of human error.
As we wrap up this explainer, I really want you to ask yourself, is your portfolio built to survive your own worst timing? Have you engineered a foundation with proper position sizing, cash buffers, and most importantly, personal conviction that can actually withstand your inevitable mistakes? Because if you're out there expecting perfection from yourself in the stock market, you are absolutely setting yourself up for failure.
It's an incredible lesson in humility, digging into the data, and long-term thinking. If you want to dive deeper into these super honest portfolio reflections, be sure to check out the full source material over at thefatinvestor.blog. Thanks for joining me on this deep dive, and I highly encourage you to keep questioning your assumptions and fortifying your portfolios.